Welcome to the MUFG Global Markets FX Week Ahead podcast with Derek Halpenny, Head of Research, Global Markets EMEA and International Securities. It's Friday, 21st January 2022, and joining Derek to pose some questions on the financial market themes for the week ahead is Chris De Sibert, Head of Institutional Investors FX Sales for EMEA. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Good afternoon, Derek.
Afternoon, Chris.
I hope you're doing well, and I have some good questions for you today because, frankly, the US dollar performance has been quite difficult to read. Do you consider the outlook any clearer going forward, especially in the context of the FOMC meeting?
Yeah, you're right. I think there has been certainly a bit of head scratching in terms of the US dollar more generally since the turn of the year, and I think this week has been no different. And I think there's a number of kind of cross currents in the markets, but you look at certain markets or certain areas of the markets and you look at price action and you think, oh, investor optimism, global reflation, crude oil prices is an obvious one that's correcting today, lower, of course, but, year to date from the low on the 3rd of January to the high this week, we're talking about a 16% gain for Brent crude oil. CNY has been incredibly resilient, clear indications of optimism that the Chinese authorities' actions to stimulate and support growth in China is bearing fruit in terms of optimism going forward. So, certain sectors of the market suggesting reflation and optimism about growth, but then of course you look at the most obvious, which is the equity market correction that's underway at the moment. We're now, in terms of the S&P 500, 6.5% lower from the most recent record closing high on the 3rd of January. That's the biggest correction since October 2020. So all the kind of risk-off episodes we had in 2021, this is bigger than all of those. So this is certainly more notable. And I think in terms of the clarity and in terms of your question, Chris, going forward, what happens from here, I think we're at a really important cusp, because certainly if equity markets continue to sell off and we go into next week and the kind of risk-off sentiment in equities continues, I would certainly expect the broadening of dollar strength and at the same time the traditional safe haven currencies within the G10 space, so the Japanese yen, Swiss franc and euro, to perform better than the rest. And that kind of trading pattern has emerged towards the end of this week. So in other words, as the equity market correction kind of becomes that bit bigger, we are reverting to what I would describe as kind of more traditional G10 trading patterns, reflecting that risk off. And that really, I think, it answers your question. If this equity market correction continues, I would expect the dollar to strengthen versus the high beta G10 currencies and to weaken versus yen and Swiss franc and euro to a lesser degree. Other way around, of course, if now yields are correcting lower in the US and going into next week, if we do see some stability, then we could see the flip of that, and the low yielding currencies could reverse and start to weaken versus the US dollar. Of course, going into the FOMC, the yield could be all the more important for the markets. We've looked at kind of the correlations between VIX and DXY, and we've looked at 30-day rolling correlations of daily percentage changes. And there is a clear positive correlation at the moment. So higher VIX, stronger dollar. And if you look back over the period since the pandemic began, that by and large has been what we have had, that positive VIX DXY correlation. If you go back to pre-pandemic, that correlation is a lot less reliable, and it flips back and forth between positive and negative correlation. And that's, of course, because the yield story pre-pandemic was more important. Because of the low yielding environment that we have at the moment, more generally, your risk appetite is a bigger driver of FX. So I think for now, I would expect that DXY VIX positive correlation to continue. But obviously, as the year unfolds, if yields can move higher and growth picks up, then we could see the correlation shift, and yield could become the more important. For next week, I think it's going to be hard for the markets to react to Fed hawkishness. I've looked back at all the FOMC meetings last year, and the biggest, by and large, the 3-week period into the FOMC meetings of last year, up until the July meeting, there was no move in short-term rates. Then short-term rates became less anchored, and we started to see some yield moves ahead of FOMC meetings, the biggest being 9 basis points on the 2-year into the November FOMC meeting. This 3-week period into next week's meeting, 3 weeks to date, of course, we're talking about a 27, 28 basis point move higher in 2-year yields. So the markets are so much more positioned for the Fed being hawkish, and a hawkish statement next week, I just don't think is going to have the same response for the markets. So less reaction perhaps, but you would still expect the rates market to remain well supported with the prospects of a rate hike in March. And generally speaking, if risk improves, the dollar versus the low yielders would be where you'd see most dollar strength.
And moving over to the euro, we saw German Bund yields turn positive briefly this week. Do you think this has any bearing on euro performance going forward?
Well, I think it is an important moment, and perhaps a symbolic moment of the changing dynamics in the markets in terms of moving away from monetary stimulus in a world where inflation risks have become that bit more significant. I'm not sure it's going to have an immediate impact. Of course, that positive moment that you spoke about was quite brief, and yields have come back down again, back into negative territory. Coincidentally, on the same day as we had that positive 10-year yield print, on Wednesday, we had the release from the ECB of the balance of payment statistics. And the consequences of negative yields in Europe is borne out very, very clearly in the balance of payment statistics. Now, this data is a bit lagging. The data is to November, but in November alone, we had foreign investors selling Eurozone long-term debt totaling 61 billion euro. Eurozone investors buying foreign bonds amounted to over 19 billion euros. So there was a net bond outflow when you look at foreign investors and Eurozone investors of 80 billion just in November. And the 12-month moving average is now at close to a record net monthly outflow of 60 billion euro. That's over 700 billion on an annualized basis. So huge net bond outflows from Europe. And certainly going forward, if some of that capital was to remain onshore in the domestic markets in Europe, that would certainly be euro supportive. Now, of course, more of that capital staying in Europe, all else equal, would actually put downward pressure on yields, or certainly it would slow the move higher in yields. But of course, all else isn't equal. And if the fundamental situation later in the year in Europe does improve, and by that, the growth outlook currently being reinforced by this Draghi Macron fiscal plan, where there's a plan being orchestrated to alleviate some of the debt burden by putting it into a Euro-wide agency debt management office, and that would give scope for governments to to loosen fiscal policy, which of course, there's a long way before that plan becomes a reality, and it probably, will be diluted to some degree. But nonetheless, moving in that direction in terms of it's positive for growth, it's positive for monetary union, it's certainly euro positive. And then, of course, we have the huge withdrawal of liquidity in terms of the maturing TLTROs, which total about 2.2 trillion, and those will start to mature in September with big liquidity drains in 2023. So later in the year, if yields are positive and we have less capital flight from Europe in circumstances of the fundamentals improving, that overall backdrop is quite positive for the euro. I think over the short term, though, the dynamics are still more in favor of the US dollar, but certainly medium to longer term, especially with the liquidity being drained through the TLTROs, the kind of fundamental backdrop for the euro definitely improves.
And last but not least, and this is a tough one, have you established any new trade ideas for readers given the current FX developments? And can you update us on your views going forward, please?
Yeah, but as I said at the beginning, in terms of, does this equity market correction continue? Do we stabilize and come back? And what happens to risk appetite? It's difficult to predict, of course. Let's be honest. So we've kind of looked at something that excludes the dollar leg. So we're looking at a short euro, long Canadian dollar. We've got the Bank of Canada meeting next week, and there is a chance they could raise rates. It's not fully priced for next week, but certainly there's a chance. More likely, there'll be more explicit guidance of rate hikes to come. And we think certainly net, even if they don't raise rates, given that that's partially priced, we think that the rhetoric should still be quite supportive for the Canadian dollar. Again, it's kind of countering in the crude oil price correction today not persisting next week. And I think that would also be supportive for the Canadian dollar. And then on the euro side, if risk off does continue, the euro upside would be less than say the Japanese yen or the Swiss franc. If risk conditions generally improve, we would expect euro dollar to correct a bit lower. So we thought euro CAD was a slightly safer way of playing the Canadian dollar positive view. So short euro versus the Canadian dollar. We still have our long NOK versus the ruble, and certainly the ruble is selling off now as we speak with the political risk premium, which is quite notable, still being built in further. And I think that has justification, and we could see further ruble depreciation over the short term.
Thank you very much for your thoughts, Derek. And I want to thank all of you listeners out there, and good luck ahead.
Thanks, Chris. And yes, have a good week.
Thank you for listening to this MUFG Global Markets podcast. Rate, review, and subscribe, and reach out to your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research Team.